Should I mute myself?
Yeah, for now.
Copy.
Hello, everybody. I'm your boss, Joe Boss. Welcome to another week ahead trading outlook stream. Man, expectations got met from last week's outlook stream that we did. And now, in last week's stream, I pretty much did a 2-week ahead outlook. I said we're probably going to go down to Wednesday, Thursday, and find a spot to reverse. And that's exactly what we got. Around Thursday, Friday, depending on the asset that you looked at, we bottomed or topped out, and we got our reversal. And now I'm expecting that reversal that we got, now here in a lot of assets on the Friday, to continue into the following week. So overall, my net expectation from a week ago hasn't changed going into the next week. And that's mostly because I looked at the calendar events, I read the outlooks, and man, it's like every single outlook that I read now is just bullish on the US dollar. Everyone is bullish US dollar. And I mean, depending on the equities that you're trading, some are seeing rebounds, some are not. It's somewhat of a mixed, dicey scenario depending on the equity sector that you're looking at or the index that you're looking at. Super mixed picture. Still a lot of upside for commodities and, gold and copper. I'm just trying to think, man, if I'm going to be setting now new expectations for the week ahead, how do I do this? Because just outside of saying like what everyone else is saying, which is long US dollar, and that's pretty much what I'm going to be saying this stream is my expectation. I kind of want to have a more nuanced view, right? I mean, the expectation for the FOMC is that they're going to be more hawkish neutral. That's going to add more pressure on higher for longer. I mean, just when it came down to the moves that we had this week, as a little review, we had advanced GDP come out at 1.6 versus 2.5, which was expected. However, most of that decline came from inventories and exports. So when people are looking at the rest of the GDP line items, it's actually still pretty good. So people are saying like, hey, this is a sheep in wolves clothing. That's how a lot of people are interpreting the GDP figure. So a lot more emphasis was put onto the increasing PCE number. And that moved bond yields more significantly. And then we got some more data that came out. Oh, and actually, once we had those PCE and GDP numbers come out, the expected first rate cut got moved all the way out into December. So it's like, hey, we're only expecting one cut this year. I mean, and I thought that was way too tight. I'm like, dude, that's super tight. Really? We're going to be doing this out all the way into December? I wasn't really sold on that. And then on the next day, we got some US jobs data, I believe. And then on that US jobs data, the first rate cut got moved to November. And so I think interpreting based off of the FOMC, the CME FOMC rate cut odds site, looking at those odds and trying to determine exactly where we're going to be by the end of the year. There's so much volatility in the expectations and how stuff can change over this year that, don't get me wrong, if inflation continues to reaccelerate going into the summer due to supply side constraints, due to energy prices going higher, manufacturing prices going higher, it's going to stay higher for longer. But with that in mind, going forward, any sort of dovish surprise in the economic data or on the FOMC commentary side of things, any sort of dovish surprise is gonna give you a big fat red candle here on the DXY. Because the consensus trade is long DXY, so anything that goes against that is going to create a really sharp and volatile movement to the downside. So that's the primary risk that I'm looking at on this long US dollar view. And so I am scouring outlooks and looking at the economic data and looking all over Twitter for commentary on any sort of view that is dovish. that's actually reputable, looking at economic data, because that's the biggest risk to any long US dollar view. So those are my primary concerns. And I think that's probably the most unique thing that I can add as far as commentary going forward is any sort of dovish economic data or any sort of dovish commentary from, frankly, people who are high up in the financial world or at the FOMC. It's going to have, it's something that we should weigh and potentially consider in our trade plans as risks. Because if that comes out, again, super volatile movements are going to follow for a lower dollar on that print. And it might just be like a really quick, sharp move lower, stay there for a couple of days and go back up. And, that's all well and good. But it's important to be aware of that kind of risk so that then, okay, if we're expecting this longer term, multi-month long US dollar trade to pan out, the risks to actually trading that are those little intermediate, like maybe week long or 3-day long spikes when we do get some sort of dovish data that goes against the narrative and sets up like a buying opportunity potentially to get back into the trend, or is significant enough data to the point where the trend starts going sideways and expectations start to change and become less hawkish. So those are the risks that I'm pointing out, but again, that's not the base case scenario that I'm really going with. The base case scenario that I'm going with is what pretty much every single person is saying in their outlooks, which is bullish dollar. Yeah. Yeah, and this is going to be hard for guys in the equities space for now. Either you really got to understand the company that you're trading quite intimately and how they're handling the current economic environment with super high rates and super high yields and what their debt looks like, what their growth looks like, what their prospects look like going into the summer. Otherwise, it's going to be pretty difficult to actually figure out exactly what to think for how like an overall equity index is going to move or how individual stocks or sectors are going to move. I mean, there are some clear expectations that you can have depending on the sector that you're looking at, but I'm not going to be going into that terribly in this stream. That's extra research and extra outlooks to read. So, with that all said and done and out of the way, I'm going to focus on looking at the odds from range probabilities and the probability pivot points to figure out what the net expectation is for where I should be expecting a high, where I should be expecting a low over the next week here for a bunch of assets. We'll start off with the US dollar exchange rates, and then we'll go to equity indices, check those out. And then we'll also check out a couple of commodities. So right off the rip, I want to point this out. Yen is up 270 pips, 269.9 pips in the last trading day here. Obviously, that's not a seasonal move. You can see most of the time the closes are down here seasonally. And this is definitely going to be a tail risk move here. If I bring up a 12-hour. Yeah, you can see but what's the probability we actually come up here? Yeah, it's like 92% of the time the high is somewhere below this value. This is just absolutely insane. I wish Oanda would give me more leverage to trade yen pairs more, because this would have been absolutely insane. I mean, I would have been net long this thing when these yield spreads started getting bullish way back here, and you can see my expectations starting to get more bullish, more range bound, up, and this was the last set of expectations I set, and from here I've just been bullish on this. No new expectations on this because I knew this thing was just going to rip, roar, and tear. But I wasn't expecting it to rip, roar, and tear going into, BOJ like this. I was not expecting the BOJ to be this hands off and the Ministry of Finance to be this hands off with the yen. I mean, I was literally reading commentary yesterday and this morning saying, hey, if dollar yen hits 158, the price that we're at right now, is probably going to induce the Ministry of Finance to step in and do intervention. Now we're at 158. I don't know what that guy who wrote that outlook is going to say now. Because, I mean, there was one wild outlook from a guy on Bloomberg. He went on Bloomberg TV and he said, yeah, there's a risk that we go to 170. And he said that like way back here before the BOJ meeting. And I'm like, yeah, good luck, my man. And now I'm like, oh, if the Ministry of Finance and the BOJ actually do continue to ignore and don't intervene on the yen, 170 is probably in the cards if you get another week like this. So not the best short in the world, to say the least. Most of the commentary that I'm seeing out of the yen is that the Ministry of Finance and the BOJ are afraid of intervening because they're afraid of a failed intervention, essentially where they go ahead and they buy all this yen back. They move the spot market like 200 pips, and then it either recovers like in a few minutes to a few days or a few weeks. When they intervene, they want to know that the intervention is going to stick. As far as timing on when they would do their next intervention, the best guess that I've seen from what I've read is that it's going to probably be after FOMC, or probably in the following week after next week. I'm not exactly sure why. I think they just want to look at what the Fed is going to do and then move their policy once they have the Fed in a set spot on, announcing its policy and announcing its position, and then move afterwards, which is actually a fairly similar situation as to what I was expecting to happen on a lot of USD pairs this week here, which was, hey, during the beginning of this week, we got a bunch of relatively good data out of the rest of the G7. And that put all these other G7 countries in a better position than the United States, at least for the first part of the week. And then going into the latter half of the week, going into the US data in the latter half of the week, it would adjust the US dollar's position and make it stronger. So it's not just the change in the economic data, it's also the timing of when the change in economic data comes in. And this makes trading super hard. It's a huge key struggling point. Being able to keep in your head like, well, for the first half of this week, European data is strong. And then the second half of this week, US data is stronger. So we're going to stay long here up until the US data comes out. Most people don't think like this. They kind of amalgamate all that information together. Like, well, given that we think US data is going to be stronger than European data, we're going to go ahead and stay net short from the beginning of the week. And then they're going to miss out on this move, not realizing that you're only getting the realized US data in the latter half of the week. And then that creates this sort of time difference in the releases that sets up its own trading opportunity. And that's just another different type of risk to look out for when setting outlooks and setting expectations. It's not always the case like this, but more frequently than not it is. So real quick. Oh, wow. Yeah, next week on the euro, this is bearish. So we're going to do some quick math here. And I know, don't worry. We're just going to add up these numbers here, roughly. So what are all these numbers added up together? What's that? It's 9 plus 9.5. So this is about 18.5%. Call that 23% plus this. It's going to be about 65-ish% of closes next week are below the central pivot. Really should add something that does that math for you and adds up all these numbers above the central pivot and all these numbers below the central pivot. So then it's just real quick, hey, here are your odds of closing above or below the central pivot. So yeah, visually you can just look at this and see there's materially less size in the histogram up here than down here. So most of the closes next week are down here. Let's go ahead and look at our highs to see what the pullback potential is on this. And yeah, most highs next week look something like that. And then you have a probability gap right here at that 0. So I would say past here, I would be concerned about reaching new higher highs, right? Because once you go past this 0, this gap in your probabilities, the assumption is that once you go past this R1.5 pivot, you're going to go to the next most likely zone. And this whole area up here is essentially a guessing game. I mean, 108 is a fair expectation in this scenario, but looking at the news for next week and the utmost bullishness of biases going into the week ahead, I would just set my expectations along this line. Let's actually use the ranges here. Yeah, so something like that would be my nominal expectation. And now let's look at our low odds here. Give it a sec to load. Lots of historical data here, and yeah, let's hide that real quick. Lot of lows down here. So something probably pretty nutty, right? And the ranges are saying probably more closer to S2, maybe just past S2 is in the cards. So let's timestamp that in. And then I think it's essentially a guess as to where the thing freaking closes. Because you do have some closes down here. That's what this little blue thing is highlighting. Most of your closes are around here, nominally, given non-seasonal data. And then you have some frequency of closes that are down here in this spot. We can use this to look at seasonal closing data points. But we already know that, there's a big range around here where you've had closes before. So this would be my net expectation, and I'm kind of skeptical even if you get this bounce here. Net, I would still expect us to have a red week, a red close for the week ahead here. And I think we're going to have a similar story for a lot of these assets. I mean, look at that. Aussie is killing it on these yield spreads. Yeah, Aussie is still doing pretty good on the yield spread side of things, so I would probably wait until the yield spreads start to flip and go more neutral or negative. I mean, very clearly you have a cluster of closes in this area right here. So I would be concerned. And I believe these are major economic events here. So real quick, I'm going to load up the calendar. We're going to go to next week, April 30th. And let's see here. What do we have for Australia? Let's see, Dallas Fed Index, Red Book, home prices in the US, New Zealand economic data, construction, manufacturing. Oh, PMIs, manufacturing PMIs out of Australia. Is that it? And then Labor Day in a lot of these places. Okay. And then on May 1st, Bank of Canada speech, Canadian PM. Oh man, then we're getting a bunch. Okay, so Wednesday is PMI day, it seems. But I don't see Australia here. Oh, there's Australia. Building permits, exports, balance of trade. Yeah. So on US PMI day, oh wow, the forecast is for US PMI to actually come in lower. Huh. Below the 50 mark. That actually might be pretty good. And then the ISM is also expected to come in slightly lower. So if these ISM numbers come in lower than expected, that actually would be pretty good. It'd be nice to see if maybe manufacturing prices come down in that sub-index. Otherwise, if the prices paid and just overall pricing sub-indices of those manufacturing components, if those are what's coming down and what's causing the manufacturing PMIs to come lower, then I'd be inclined to actually maybe stay a little bit more neutral, and then on those releases, on that realization, maybe get risk off on the dollar, essentially short the dollar. But we'll have to wait and see. And given the trends that we've had recently economically, it's not looking like that's going to end up being the case. So again, nominally, most of the closes are somewhere down here for the Australian. And that's just my email, the little ding there. Let's look at our high odds here. Where do most of our highs come in next week? Ooh, yeah. So maybe there's like 30, 40-ish pips of upside left. And then it becomes a guessing game past this R2, essentially past 65.8. So let's go ahead and set in our nominal expectation of a bit of up. Maybe one more day ahead. And then for a bit more follow through into a low. I mean, probably be one day sooner here. Oh, wow. Yeah. Pretty unlikely to get your low around here. And FYI, this is average true range pivots. We can go to traditional and check those out too. This is saying, hey, a lot of your lows are down here. And this is pointing out the risks of going, even lower. But I'd be more or less open to this spot here, using the average true range pivots. Oh, that's kind of interesting. So you see this spot right here kind of lines up with this spot here. in the ranges. So that'd be like a move like that. That'd be, I would only expect this sort of move on a beat on the manufacturing PMIs for the United States. So if those PMIs come out really strong on the US side, then I'd expect this sort of move. Otherwise, my more nominal expectation would be something along these lines here. So let's go ahead, plop that in, go with red. And if I'm not mistaken, right, a lot of our closes are still in this spot here, right? Yeah, so it might be more prudent to set the low down to that original spot way down there. Because if I'm expecting a close around here, the low has to be lower than the close, right? Or equivalent to. So your close and your low have to be either at the same spot, or your close has to be higher than your low. So while this is a more extreme expectation, and I could very easily be wrong on this expectation, this is probably what I'm going to have to end up going with based on the odds that I'm reading into all of the super bullish US dollar expectations that I'm also reading. I don't want to bet against the market's bullish dollar expectations. And considering that some of the odds are lining up for those dollar bullish expectations. Oh, one sec. My bad. I just need to turn off the notification for the emails because I'm still getting outlooks sent to me here. And mute tab. All right, we're good to go. So yeah, I know this is I very, very frequently set these sort of expectations, and it seems crazy to some people, like, oh my god, you're expecting essentially 130 pip move here to the downside. I'm like, yeah, but that's just what the data is telling me. And while this is my nominal expectation given the data, and given my impression from reading these outlooks, I already, just by looking at these odds, I can say, like, hey, past this R2, I probably don't want to be so bearish anymore, right? So we can set an alert here and timestamp here, 0427, and put something along the lines of like risk on, right? We could do something along those lines just to identify these risks. But I still wouldn't be super, I mean, you do have those, yeah. We're going to have to see what the data comes out for. And again, there's not that much Australian data coming out next week. So remember what I said earlier for the last week, which was, hey, we got a lot of G7 data. Well, next week, yeah, we still have some G7 data coming out. But when it comes down to Australia, it's not that much compared to what we're getting out of the US. So the moves next week are going to be very, very US driven. So let's do the same thing, just on the New Zealand dollar now. Looks like the yield spreads are improving somewhat on that 12-hour. How about here on the daily? Yeah, short term they're improving, but long term, intermediate term, they're pretty much flat. So this is quite a volatile yield spread here. So I'd be definitely more cautious on the New Zealand side of things. The expectations for New Zealand are not so great. But these odds do look good for some upside, even though these are fairly thin, in my opinion. You can see like, hey, a lot of highs are around here between R0.5, R1, and then you have this way up here by the probability weighted pivot around R2, R2.5. But this would be in the bullish scenario that I'd be expecting a move way, way all the way up into here. Let's look at our closing odds real quick. And nice to see you all watching. Remember to leave a like and all that. And if you want me to look at a particular asset, make sure to say so in the chat and I'll go and check it out. Oh my god, this looks exactly like what we saw on the Aussie and Euro. Most of the closing odds are below the central pivot. You can see, I mean, this looks, oh man, yeah. I actually want to turn on the strategy dashboard here. And I want to see which strategy out of the range, continuation, and the standard work out here. So you're going to see something new hop up here. So this is a feature in the probability pivots that summarizes the odds of all of these probabilities here on the right. So then instead of having to switch between close, high, low, I can just read this here and get the odds that I'm looking at. The range bearish odds, you know, these range odds, they hit their stop loss quite a lot this week. Actually, a lot of odds hit their stop this week. Next week is pretty volatile. Actually, no, that's for this week. See, current period. Next period is down here in the second part. I'm pretty sure if I... Yeah, I gotta add something here so that I can just show the next period's samples and stuff like that. Okay, let's see here. Which one has the lowest odds of getting stopped out? That's actually the range bearish odds here at 57%. And it actually has the highest probability of overshooting. Yeah. 0% of the time, though, it hits its exit. So this thing overshoots every time it hits. So that's pretty nutty. A lot of these are pretty low hits on the exit. Pretty low hits on the entry side of things. So this is going to be a pretty volatile week ahead of us. Low chances of drawdown when these things do hit. And wow, check this out. The strategies with the highest probability of closing at their target or past their target is actually the standard bearish bias and the range bias. So real quick, to demonstrate that, I'm going to actually update the biases here to standard bearish. And you can see what it looks like here. So that means getting short, like right off the rip, 33% of the time it stops out, right? Let's see. And, oh, this is on closing us. So 33% of the time we close above the stop loss. Yeah, and this is huge. Yeah, and there's some overshoot here. That is huge. So this is for closing odds. And then if we look at the low odds here, because when you want to go short and hit a target, your low needs to hit this spot here. Wow, 52% of the time your low goes lower than S2. That's a lot. So it's only roughly 20% of the time next week that the low comes in here for New Zealand. Actually, I'm going to take off the biases and hide the strategy dashboard real quick so we can look at this thing in full. Yeah, check that out. Most of your lows are either down here at the prior week's low or down here past the low from 2 weeks ago. So this is really bad. So while the high odds are pretty spread out here, and you do have this spot here for a likely high and this spot here for a likely high, those highs are definitely not as clustered as these lows, right? Clearly there's a cluster of lows here, a cluster of lows here, and a cluster of lows here, separated by some probability gaps. What about China data? Yes, actually, you know what? I was looking at that, and the China data absolutely could help Australia and New Zealand particularly. So I will be watching the China data. That actually is a really, really good question to ask. Because when I was looking at the economic data, I'm like, there is China data next week. There isn't a whole lot of New Zealand, Aussie data that's super significant next week. So maybe that will end up being the thing to watch. And I actually absolutely agree with you. If that China data comes out really, really good, that could help. But again, the main driving force here for next week, I think, is still going to be the dollar. And if the US dollar economic data comes out good, or if it comes out neutral, or if it comes in slightly or more below consensus. As a little refresher, just to help with setting expectations for people who are like, well, why does this matter? The growth of China, I'll just draw something real quick. If the US is growing like this and China is growing like this, the US is going to outperform. And the US, more people are going to want more US dollars because guess what? You get paid more. There's a higher cash rate for US dollars than holding Chinese yuan. So you're going to see an appreciation. If the United States looks like this, and let's say Australia and New Zealand, you know, go from looking like this to looking like this, as far as our future expectations are concerned, I can change the color there. That's actually not that different of a color. If Australia and New Zealand on this blue line start having better growth expectations than the United States and lower inflation than the United States, the currencies will start to improve more significantly. But I have to caution against that expectation, specifically because we have to see that data actually realize itself. We have to see that data actually come out good before we set those expectations. So we can do this thought experiment where we can say, okay, what are the scenarios where Australia and New Zealand start to see some appreciation in their foreign exchange rates? And that would be the scenario. So that's what would be on the outlook for. That's what we'd be waiting to see the data provide for expectations and forecasts to update into that direction. But right now, that's not where we're at. Right now, U.S. inflation is relatively high, U.S. growth is relatively high, but U.S. rates are also high. So there's kind of three components there. It's inflation, employment, growth, and cash rates of the central bank. Those four factors across every single country need to be compared, and the rate of change of those four factors also needs to be compared. And then the timing of the release of all four of those factors against all these countries need to be compared. So maybe you can see now why trading is pretty hard. Can we do outlook for cryptocurrencies, Bitcoin? Yeah, sure. I'll do Bitcoin in a bit. Yeah. So when I'm looking at this chart here, I'm like, okay, either this thing's going to find a low right off the bat, or I probably want to stay short this thing. And again, given my outside of the China data, and it's not just one China print that we need to turn out good, you know, that might mitigate the amount of fall that we have, but we need a few more good China prints to come out also over the summer. Really, a lot of the bearish dollar sentiment is hooked on US inflation coming down, US growth coming down over the summer. So between now and June, maybe July, it's dollar bullish season until the data turns around sometime around probably July, because the Fed's likely going to still be on pause, if not stay neutral at least into June. So I'd say maybe end of June, we maybe start to see some dollar sideways weakness come out. But it's more likely to be like middle of July once we start getting economic data, hopefully performing well out of the rest of the G7 in the middle of July. So there's always this thing where it's like, okay, we're looking at expectations months and months out. What does that have to do with where we are right now? Well, it puts into context where we are right now and where we could end up. Because what if the US data changes faster than we expect that make markets go risk on? Well, because we've already planned and looked at these scenarios, we can just pull forward our expectations and just copy. Oh, well, we already thought about this scenario. The data is turning positively for the G7 much quicker than we expected. So now we can pull forward our bullish expectations that we had for 2 or 3 months out from now. And you'll frequently see that if you read outlooks from institutions. They'll set an outlook for like a year ahead or 6 months ahead, and the data will turn a lot faster in favor of their expectation that was 6 months out, and they could realize in about a month or two their 6-month expectation. So it's important to have a nominal view what you currently expect given the information that's provided to you, and then update your expectation as new information comes available. And I really hope that makes sense, because that's kind of the crux of what we're doing here. So real quick, I would probably set my expectation net just to be bearish down to here. For New Zealand, probably on the week. I have no idea about the timing. But I'm also going to do one more thing, because I am concerned about this spot here. I'm going to kind of draw my line roughly around here. Set this thing to red. Set this thing to red, because I used red for my bearish expectations. Risk off. And then I'm going to draw another set of expectations down to here towards the end of the week, post all the economic data that we get out. So I kind of have a contingent, this is my nominal expectation down to essentially sub 59 on New Zealand dollar, and then pretty much reaching the lower 58s on a particularly strong US economic report. And if we look at our closing odds here real quick, one last time. Yeah, most of our closes are also around here, so maybe this is a bit lower. Maybe we go into the mid 58s and then either go sideways or a rebound. We can kind of split the difference there. Oh, and check that out. When we use non-seasonal data, we have a peak in our closing data for next week right here. And this is where we get most of our closes for any given week up here. But there's a peak right about there. So nominally, I'd expect down and then up like this. And we'll timestamp that so we don't lose track of our expectations. And then this would be like, oh no, the US is doing too good scenario, right? So that'd be my expectation for New Zealand. Now let's head over to the CAD. And again, thank you guys for watching. Appreciate that the stream is growing and all that. And it looks like the yield spreads are starting to improve for dollar bullishness. Maybe, yeah, looks like we're now starting to flip again. Looks like our expectations held up really, really well for the Canadian dollar. We expected down to around here and then up into a close. I'd say within margin, we pretty much nailed that. And looking at next week, it's pretty split between bullish and bearish expectations. Also, I'm going to delete that drawing. Looks a little bit ugly. And that expectation was wrong. That expectation was correct a bit, but wrong in magnitude. So it's not like I don't set incorrect expectations or miss my expectations. Sometimes I'm very on it. Sometimes it's not a match. It's not a hit. Things change too quickly. And it's just important to watch your expectations change over time. So then you can see when you set an expectation, how likely you are over time that, and you can review like, okay, why wasn't my expectation met? And then you can review in outlooks, in the economic data, talking with other traders like, hey, I had this expectation, and then the data came out this way, or the market moved this way, and I don't know why. Why did it move that way? And then it's your job to figure out and teach yourself, okay, what information am I missing here? What did the market price in that I'm ignorant of? And over time, you build up a repertoire of all this information from setting an expectation and then having your expectations hit right on point because you nailed the expectation. Like, all right, good, I know what I'm doing. Or you miss your expectation, you overshot your expectation, whatever it is. You then learn, like, okay, what caused the discrepancy there between what I thought was going to happen and what actually happened? And when I look at these odds for next week, I'm like, dude, I can't say this thing will go, it can go either way, in my opinion. Yeah, it has a bit more of a bearish skew to it, but given the position, the relative difference between the cash rates at the Bank of Canada and the FOMC, those are some pretty strong high odds. I just need to be quiet now and put this up arrow there. And before I eat my words here, I'm gonna draw this thing out into the future and leave some room here just in case I need to draw something here to the downside. Yeah, so maybe something along these lines where it's a down move, and you'll notice that I've been essentially drawing the same thing for a lot of these assets, which is a little bit more appreciation on their end for maybe the first 24, 48 hours. And then from there, getting weaker into the middle of the week, potentially into Thursday. And if we look at our high and our low ranges, you can see we are lining up with non-seasonal probabilities as well. A lot of lows, in fact, most of our lows for a given week show up around here. Seasonally, they do too, which is nice. And a lot of our seasonal highs come up here, and a lot of our more dollar bullish highs come out around here for the USD Canadian dollar next week as well. Again, I'm not so sure on the closing expectations here. Maybe, again, bit of a pullback, but that's essentially been the call for a lot of these assets. So that'll be my nominal view. Let's see. Let's do Bitcoin, BTC USD. And looks like we rose after the halving, and now we've fallen a bit. Yeah, seems like we're just going to be getting more sideways action. I see a lot of people getting super bearish on Bitcoin here. And sure, maybe it gets a bit more bearish. But I mean, I'm looking at these lows here for next week. How much data do we have for next week here? I want to turn these off here, so I just get the sample numbers. That's all I really want is the samples. Waiting for this little thing. Yeah, we have 13 years of data here. So if we're going to trust the historical data, most of our lows are going to be around here and closer to this S1.5, which is around, you know, just below 6,200, which is roughly equivalent to these prior lows around here. So yeah, I'd expect some sort of pullback on Bitcoin next week. And 27. But I have a feeling it's going to look more like this if I could check out the highs here. Yeah, so something along here and then like that. So essentially range bound next week. You can see lows here, highs here, going to a high, going into a low, essentially range bound. Oh, actually, I need to update that to be red. And that will be green. So this would be my nominal expectation for Bitcoin going into next week. Let's see, what else could we look at? We could look at crude. So what's to the high side on crude? Well, a lot of highs come in right off the rip, but also way up here. And I wouldn't be surprised to see more or less oil stay sideways in this next week. Yeah. So if there's a particularly strong dollar, yeah, seeing $80 oil next week, not out of the question. But I think it's going to be more or less along these lines, maybe. To be frank, this is not a particularly strong expectation. But I actually do know something. We do have an OPEC meeting next week. So that's why I'm setting a bullish expectation here in the latter half of the week. I think it's on Wednesday, so that'd be May 1st. So probably something along these lines here. So if OPEC comes out and they are particularly, you know, holding, let's say they're just going to continue to hold on their supply and all their production mandates and potentially threaten, you know, we could do more cuts. Yeah, that would send oil higher. And there's concerns that I've read in the commentary about the OPEC meeting being more bullish for oil, but you know, I've only read like 2 articles on the OPEC meeting. I expect to get more outlooks and more detailed analysis over the weekend here and going into Friday. So that's really what I'm waiting on, to have a clearer view of what to expect for this OPEC meeting. But just looking at the data, just looking at what I know and what I've seen so far, this would be my net expectation on oil. And yeah, I hope you enjoy that crypto bit. And let's see here. What else? Gold. And I haven't done the equity indices. You can see my gold expectations have been a bit off the way. And yeah, hit that probability weighted pivot low on the week. This thing's probably going lower again next week. Yeah, I appreciate it. Yeah, probably up a little bit more and then down. That would be my expectation. I'm not so sure that all these world governments that have been buying all of this gold for this entire run-up are now keen on buying more gold at these prices because gold is really expensive now. So I think we're going to see a little bit of a more range bound move over the next week. Maybe not a total fall off like below this low, but this would be my net expectation going into the week ahead here. We can check out the ranges. So the ranges are a bit more conservative. This would be particularly bullish. But again, given the pivots, given the seasonal data, it's either this little tiny move here to the upside or this spike here. And I'd rather go with the spike, a bit more hopeful on gold than just a little tiny move. And then on the downside, yeah, somewhere around here, we can do something a little more conservative. Yeah, so something along these lines. Now for the ES and the NQ, and then we'll call it. Yeah, very low probability of finding your low here. This week is like 16%. Next week's not looking good for the S&P. How about on the high side, real quick here? Yeah, maybe a little bit of a move up. Yeah, essentially to R1.5. And let's go ahead, set that to green. Timestamp that. Look at our low odds here. And then that's really bad. Those are some really bad seasonal odds here. I actually really hope that doesn't happen. Especially if US growth slows down a heck of a lot. Especially on the manufacturing side. If those US PMIs come out terrible, this is really not going to be good. If the China data doesn't come out good, that could also hurt the S&P. Because a lot of companies really need China to be doing well to kind of boost their performance still. So if those China PMIs don't come out good, it'll be good for the US dollar. It's not going to be good for a lot of these assets. NQ. Yeah, NQ is also pretty darn bearish next week. Somewhere around here. These are huge moves. This is not a good week ahead, guys. I mean, there's really good odds of still going higher next week, so I'm still pretty hopeful about that. But I don't know, I just want to stay cautious next week. I'd want to stay very cautious next week. I could be very wrong on these expectations. Very, very wrong on these expectations. All sorts of surprises can occur, and I'm just setting my expectations based off the odds that I'm seeing here and the bit of intermediate data that I have going into the week ahead. I'm going to be getting more outlooks to read over the rest of today and tomorrow. And in about 40 minutes from now, if you're in the trading group, you'll be able to join me for an outlook review session where we'll be reading through some of the outlooks that have come out so far this week, and we're going to be taking notes on those outlooks. So if you guys would like to join in for that and you don't have access to that, you can do that for free. The link to it is in the description. The WAP store, it's the trading group plus indicators one, so it comes with all of these indicators and the trading group. So if you want to hang out and go over some of these charts with some of these tools and go through them for not just this week, but the week or the month ahead. And speaking of the month ahead, tomorrow there's going to be an extra stream. There's going to be the month ahead trade plan stream where I go over the monthly expectations with monthly ranges and monthly pivot probabilities. And if I do this, we can actually take a real quick sneak peek at next month's odds. And you can see a lot of highs right around here and a lot of highs right around here. So what is that? 18,400 would be really good for bulls. And if we check out the low odds here, wow, 20% of the time you go past that S5 ATR pivot. A lot of lows are still right there, right off the open. And then there's some lows here around, call it 17,600. So this is like the primary risk. I am net bearish May, but I have a more strong conviction on being long the US dollar throughout the month of May. So we'll be looking at this for the month ahead for all these different assets in tomorrow's stream. It's probably the only time I'm doing streams on a Sunday. So if you want to stay tuned for that, go ahead and subscribe. I mean, if you've watched all the way through here, absolutely do. Leave a like and hop on into the Discord. Weren't earnings good this week? Yes, earnings were good this week, but you can see the kind of choppiness. Even if earnings were good this time around, now the focus is on what are the expectations for forward guidance? What are the expectations for the next quarter's earnings? So while some stocks like Tesla rebounded really, really well, their earnings were actually bad. But they set really good forward expectations. They said, oh, we're going to begin working on really cheap cars, really, really affordable EVs over this year and potentially get them out by the end of this year. That's why we had this jump up. Also, a lot of people think that this trend lower in Tesla is overdone and that for people who are really bullish Tesla, that this was a good forward outlook on future expectations. So while this earnings report did have an impact on the markets on a lot of assets, the next earnings report is gonna be more revealing as to the long-term performance for a lot of companies, and the forward guidance that companies give essentially over earnings week and over the next week here is going, and how the market digests those promises of those future expectations is going to be very, very, very important. And I hope that was easy enough to understand what I said. And yeah, with that all said, the stream's a little bit over an hour, about an hour and 10 minutes. Covered pretty much everything that I wanted to cover. And I'll see you all in the Discord, and I'll see you all tomorrow, and I'll see you all in a bit.